Want to make your money work for you, but don't know where to start? In this video, we're breaking down different investment options, from safe choices to high-risk, high-reward strategies, so you can build wealth the smart way. Welcome to the House of Resilient. Investing isn't just for the rich. It's for anyone who wants financial freedom. Whether you're looking for steady growth or willing to take risks for higher returns, there's an investment option for you. Let's dive in. Stocks are one of the most popular ways to invest. When you buy a stock, you're buying a piece of a company. If the company does well, your investment grows. If not, you could lose money. Growth stocks offer higher risk, but potential for big profits, often seen in tech companies like Apple or Amazon. Dividend stocks, like Coca-Cola, pay you regular income and have a lower risk profile. The risk level for stocks is medium to high, best for long-term investors who can handle market ups and downs, like the 2008 financial crisis or the 2020 COVID crash. Bonds are loans you give to governments or companies. In return, they pay you interest. They're less risky than stocks, but usually offer lower returns. Government bonds, like U.S. Treasury bonds, are safer with current 10-year yields around 4.2%, offering stability even during market downturns. Corporate bonds carry slightly higher risk, but can offer yields of 5 to 6%, with investment-grade bonds defaulting at less than 0.5% annually. The risk level for bonds is low to medium, making them best for conservative investors looking for steady income, especially retirees aiming for predictable annual returns. Real estate can be a powerful wealth-building tool. You can buy properties to rent out or invest through real estate investment trusts or REITs. REITs let you invest in real estate without owning physical property, offering diversified exposure with a 4% dividend yield and 7 to 9% historical annual returns. Rental properties are hands-on but generate passive income, while REITs require no management but offer lower control over assets. The risk level for real estate is medium, influenced by interest rates, but it's suitable for those seeking inflation hedges as property values often outpace CPI by 2 to 3% annually. Want diversification without picking individual stocks? Index funds and ETFs are perfect. They track a market index like the S&P 500, spreading your risk across multiple companies. The S&P 500 ETF has averaged 10.7% annual returns over the past 30 years, with low expense ratios under 0.1%. Index funds are great for hands-off, long-term investing, while ETFs are traded like stocks, offering more flexibility. With a low to medium risk level, they are perfect for beginners and long-term investors, as Warren Buffett recommended allocating 90% to an S&P 500 index fund. Cryptocurrencies are digital assets like Bitcoin and Ethereum. They're highly volatile, meaning prices can skyrocket or crash quickly. Bitcoin surged from 9 cents in 2010 to $69,000 in 2021, but fell to $16,000 in 2022. Offering 230% average annual returns from 2013 to 2023. Pros include high potential returns and decentralization, while cons involve high risk, regulatory concerns, and significant price swings, like the 2022 FTX collapse. With a high risk level, crypto is best for risk-tolerant investors willing to ride market waves, with experts advising only 5 to 10% portfolio allocation. Looking for something different? Alternative investments include gold, commodities, collectibles, and even startups. These can hedge against inflation and diversify your portfolio, with gold returning 5.5% annually since 1971 and commodities fluctuating with events like the 2022 Ukraine crisis. Startups via venture capital offer high risk, high reward, though 75% fail. Art and collectibles, like a Picasso sold for $179 million, appreciate 5 to 10% yearly. The risk level varies, but they are best for diversification and long-term value seekers, ideal for 5 to 15% portfolio allocation to mitigate stock-bond correlations. There's no one-size-fits-all investment. Your best option depends on your risk tolerance, financial goals, and time horizon. Diversification is key. Mixing different investments can reduce risk and increase potential returns, like a 60-40 stock bond portfolio returning 8% with 12% volatility. If you found this helpful, hit that like button and subscribe for more smart money tips. Let us know in the comments. Which investment option are you interested in?